Welcome everyone to another episode of Keys to Home Buying. I'm a little behind on my most recent episode. I actually lost my voice the last couple of weeks. It's still a little bit hoarse, but good enough to get through today. So if you haven't heard from me or seen an episode in a while, that's why, but I'm back now. Today's episode, I'm going to be going through FAQs, frequently asked questions that I hear a lot. I've got a good list. Next week, tune in. I've got an interview with Lisa Campion, an attorney in Vermont who I work with a lot and is fantastic. We're going to hear about what she does in the process. And I think that's something that a lot of people don't really know about as a buyer. And it'll be some really good info. So tune in for that one. But let's just dive right in here. I've got 1, 2, 3, 4, 5, 6, 7, 8 different questions we're going to go through, and I'm going to try to go pretty quick. So we'll just start at the top. Do I need 20% for a down payment? This is one of the super common ones, and to me, kind of wild that it's still common these days. But no, the answer is you do not need 20% down 95% of the time. So it all depends on the loan product and the property itself. But generally speaking, we'll go through them real quick. So conventional, if you're buying a single family residence or a condo that is your primary residence, your minimum down payment is either going to be 3% or 5%, depending on your income or if you're a first-time home buyer. If it's a 2-unit primary residence with conventional, it's going to be 15% down. And if it's a 3 or 4 unit, that's where you need at least 20% down. But that's pretty rare. Most people are buying single family homes for themselves. Maybe they're stretching it and doing a duplex. If you're using FHA financing, which is primary only, that's going to be 3.5% all the way up to 4 units, 3.5% for your down payment. VA and USDA are both minimum 0% down. VA, you can go up to 4 units. USDA has to be 1 unit, both primary only. Now, if we're looking at investment properties or second homes, so a second home is like a vacation home, right? The intention is not that you're going to rent it out all the time. You're actually going to go there to spend some time there part of the year. If it's a second home purchase, has to be a 1 unit. That's 10% minimum. And if you're doing an investment, it can be anywhere from 1 to 4 units. If it's a 1 unit, it's a 15% down minimum. If it's 2 to 4 units, it's a 25% down minimum. So again, those are pretty rare when people are buying the 2 to 4 unit investments where you do actually need at least 20%. Majority of the time, especially if you're a first-time home buyer, your down payment is going to be somewhere between 3 and 5%, 9 times out of 10. Next one, is a deposit the same thing as a down payment? You may not even know that there were 2 terms like that. Obviously, you probably heard of down payment, but deposit, a lot of people assume that's the same thing as a down payment. So when you're working with a realtor, you submit an offer. Even when you're not working with a realtor, if you submit an offer, typically the seller wants to see what's called an earnest money deposit to go along with that offer. And what that is just an amount, typically 1 to 2% of your offer amount, to give up front with your offer, to put a little skin in the game, show that you're serious, and to add some extra security to the seller because they can hold on to that money if you back out of the contract for any reason outside of your contingencies. Contingencies are a whole other topic. I believe I talked about those in another episode, but we can always talk about those again. So the deposit itself is held onto by the seller or the seller's agency. And at closing, that money is given and applied to your down payment and closing costs. So say your down payment and closing costs totaled $20,000 and you gave a deposit of $5,000 up front. That means you only need to bring $15,000 more to closing because $5,000 is already there via your deposit. So think of it as a prepayment towards the down payment and closing costs. What are closing costs? I did have a full episode on what these are, so tune into that one where I seriously break it down. High level, just to answer it FAQ style, these are typically one-time fees to handle all the services that go into closing on a home. So your attorney, the appraisal, the lender fees, paying people at the town clerk's office to update the land records. There's this thing called a transfer tax in Vermont that anytime you purchase property, you pay tax. That's part of it. And then there are other things called prepaids. Most of the time, we just roll that into the term of closing costs when we're talking. But prepaids are for your property taxes and homeowners insurance and prepaid interest on the mortgage. And that stuff, you could look at it as a cost if you want to. It's not really a cost of the purchase because you would have to pay that stuff even if you were paying cash. So How you want to look at that is totally up to you. But if you want a more in-depth breakdown of closing costs, tune into my episode 2 or 3, I think. That's where I break down every closing cost that you can expect. Will you need to pull my credit, and will it hurt my score? Will I need to pull it? The answer is maybe. Will it hurt your score? Answer is unlikely. So will I need to pull it? It all depends on how serious you want your pre-approval to be. So there are 3 levels of an approval before going under contract. There's a pre-qualification. That's number 1. Number 2 is a pre-approval. Number 3 is a fully underwritten and approved loan. Each one being stronger than the next in that order. So a pre-qualification is where I haven't pulled credit. I probably don't have any docs from you like pay stubs or bank statements, W-2s. We're just talking. You told me how much money you make. You told me a rough idea of what your debts are. And in turn, I tell you, it sounds like you should be approved for X dollar amount in purchase price. That's a pre-qualification. You can't do much with it. Some realtors will still show you houses if you're pre-qualified, depending on your relationship with them and their relationship with the lender, and just kind of overall confidence of that pre-qualification. But you can't submit an offer with it. So the next step is a pre-approval, where there's different definitions depending on the loan officer you work with. Some, they just want to pull credit and they're happy. Personally, I like to pull credit and get every document up front so that we have a clear picture of your situation and we can confidently get you a pre-approval so that you can go into that offer or home search, again, with confidence. So that's my version of a pre-approval. We've done everything except had underwriters look at it. The next one is a fully underwritten and approved approval. That's when I've done everything for the pre-approval and I did send it to the underwriting team. They treated the loan as if you were under contract on a home, but obviously there's no address, so they look at everything else. This is great because once you do go under contract, we already have financing secure. We just need an appraisal and title work and for you to not quit your job. So that's the strongest approval there is. It is more time consuming. So a normal pre-approval, if you're a salaried employee and you don't own any other homes, then we could get that pre-approval turned around in an hour or 2 if you're fast with getting the documentation. If you're self-employed, plan on maybe a day, maybe 2 days, because there's a little bit more that goes into that one. For a fully underwritten and approved loan up front, that's going to take, call it a week. We can sometimes do it faster. It depends on what's in the pipeline for our underwriting team. If we're really busy, it's going to take a little bit longer. If we're slow, they can probably get to it faster. Will it hurt your score or the credit pull? It shouldn't, right? So if you have really good credit, especially, this hit isn't going to do much. The credit bureaus look at the credit pull from a lender a little bit differently than credit pulls from somewhere else. They know if a mortgage lender is pulling credit that you're looking for a house and you have to know what your score is. So they're not going to penalize you for that. There's also this grace window where if I was to be the first lender to pull your credit, it begins the clock, a 2-week window where other lenders can pull your credit and it has no additional impact on your score. Beyond that, if you were to wait the full 2 weeks and then a couple of days later have someone pull your credit, that's where you might start to see a detrimental impact to your score. So that's what you don't want to do. You don't want multiple consecutive credit pulls that are outside the grace window, because then it's a question for the bureaus. Okay, why are they pulling their credit so much? That's not good. And that just increases their thoughts of risk. Thus, your scores go down. So you do want to be infrequent about it. Most reports will expire 3 or 4 months out. So if you're waiting 3 or 4 months before you have it pulled again, you should be okay. Next one, will I need an appraisal and how long does it take? 9 times out of 10, yes, you do need an appraisal. So if you're doing a purchase, sometimes we get appraisal waivers on purchases. That's when our automated systems kind of have a really good idea of what the property is worth already. It could be because the investor that financed it currently, the current home's loan was financed through. So if they used Fannie Mae conventional financing and they closed on it 3 years ago, well, that's in the Fannie Mae system. And if we run it through, they may already know what the value is from that 3 years ago appraisal. And looking at market conditions today, they can just kind of determine like, yeah, okay, it's not unrealistic that it's now worth X. So no, we don't need an appraisal. And they knew it was in really good shape back then. So we're all good. That's less common than if you were to do a refinance. In a refinance, we do see appraisal waivers fairly often. I would say plan on an appraisal being needed. And if you don't need one, that's just like a bonus. How long will it take? Really depends on the area. So in Vermont, if it's Chittenden County or the kind of outskirts of Chittenden County, we're seeing these turned around within a couple of weeks these days. It's March 16th, 2023. Back in, when COVID was happening, it was taking sometimes a month and a half to get an appraisal back, sometimes 2 months. So it depends on market conditions. If you're looking outside Chittenden County, like in southern Vermont, those can still take maybe 3-4 weeks at times. Again, it depends on availability of appraisers and how busy they are. Do I need to get a property inspection to meet financing requirements? Almost every time, no. The only time that we require a property inspection is if you're getting renovation financing and we need a HUD inspector to be at the property to look at everything in the project to determine what needs to be done to meet HUD minimum guidelines. Even that's pretty rare. Otherwise, if you're just doing a normal purchase, no, we do not require an inspection, but we always recommend it because if you're buying a house, you're not going to see everything under the hood just at a glance, unless you are a professional or if it's a brand new build. So you do typically want to have an inspector go in there and take a really good look at things so you know exactly what it is you're buying, but it's not required by us. C, 2 more. How do I bring the money to closing and who am I giving it to? This is a great one. Get this one on almost every loan. And basically, at the very end of the process, about a week before, you're going to get a closing disclosure, which is going to detail down to the penny how much money you need to bring to the closing table. That money is going to be given to your attorney. They hold on to it until paperwork is signed, and then they disperse it to whoever needs it. How you get it to the attorney, typically they'll accept a wire transfer or a certified bank check. I haven't heard of any other methods of getting the money to closing. You do want to make sure that you bring a personal check with you because sometimes there are variances that come up at the closing table. So maybe you have to bring another $200 and you can just write a personal check for that. So that's how you bring the money, and who you're giving it to is your attorney. Last one, what's your rate? Probably the most common question I get. And the answer is, it depends, right? We can kind of have a general idea of what rates are. If you look at the TV behind me, this always has what the bond market is currently doing. And you can't really see it, but this graph here, I'm going to try to point to it with my finger for anyone watching on video. For those who are listening, just know we're looking at a candlestick chart and we're looking at mortgage-backed securities. When the mortgage-backed security market is up, rates are going down. When it goes down, rates are going up. So right now you can't really see it, but we are on a rebound. So rates got a little bit better in the last couple of days than they were last week. But generally speaking, rate is dependent on a variety of factors, including but not limited to down payment, property type, occupancy type, credit score. Soon debt to income is going to become a factor. Those are the big ones. How many units? So it really just depends on a variety of things. I could quote one person at 3:00 today, a 7.5% rate. I could quote someone else, 6% rate, and both would be correct because their situations are completely different. This person could have a 600 credit score and buying a 4-unit property. This other person could be 800 credit score and putting 50% down on a 1-unit property. So it really depends on your situation. The best answer is let's get you pre-approved and see where you're at based on what you're looking for. And then I can give you a realistic rate. But honestly, the thing with interest rates is they should be a secondary concern to these 2 other things that, in my opinion, are way more important. That's cash to close and monthly payment. If you can meet your budget for your total cash to close and your monthly payment and you love the house, the rate could be 1,000,000%. Who cares? You can afford it and you love the place. The rate is technically temporary because you could refinance it later on. So why let that bog you down? Rates are going to be what they're going to be. We can't control it. If it's the right time for you to buy, then it's the right time for you to buy. So those are the frequently asked questions I get. I'm sure there are plenty more that I'm not thinking of. If you think of any and you want me to go over it on the next episode, let me know. Email me at jmead@homebridge.com. Again, be sure to tune in next week. We got Lisa Campion, attorney with LMC Law. Can't wait to interview her. It's going to be a good time. I hope you all have a great week. Talk to you later.